Hello and welcome to Stockwatch Live. New figures out from the British Retail Consortium show that the woes on the high street continue unabated. The number of empty shops in town centres is at its highest for 4 years, with 1 in 10 now lying empty, as thwarted retailers pack up and move out. Out-of-town retailers, though, haven't fared so badly, according to the latest data. So, pet goods retailer and veterinary chain Pets at Home, which is found in these out-of-town locations, may have been spared the worst of it. Revenue for the 16 weeks to the 18th of July rose almost 10% to just shy of £303.5 million and included growth of almost 9% in the retail division and 19% in the veterinary division. As a result, it said it expected its annual profits to be slightly above current market expectations. Caution prevails, though, as the uncertain consumer climate and the problems it suffered rolling out its veterinary franchise may still be causing concern. Back in May, Pets at Home saw a 38% fall in full-year profits after it had to buy out a number of underperforming joint venture practices. The company forecast a slight decline in underlying profits for the current financial year as it cut some of the fees paid by its veterinary practice joint venture partners. It may have described itself as cautiously optimistic, but brokers seem more pessimistic. Goldman Sachs remains a seller, but has raised its price target to 155 pence. HSBC has downgraded its investment rating to hold from buy, and Berenberg is also sticking on hold, but has raised its price target to 175 pence. We can probably expect more retail gloom on Thursday when homeware retailer Laura Ashley posts full-year results. It's already warned that full-year results will fall short of market expectations after reporting a first-half loss. The company said falling revenues from furniture and decorating products were to blame, and that given the continued market turbulence and having reviewed the revised management forecast for the second half of the year, the board now holds the view that the performance for the entire year will fall short of market expectations. For the 26 weeks to the end of December 2018, the company reported a loss before tax of £1.5 million, compared with a profit of £4.3 million a year earlier. Total group sales fell 8.8% to £123 million, and total like-for-like retail sales were also down as well by 4.2%. It's not a news story, though, from Laura Ashley. This time last year, it reported a slump in full-year profits, which came in at just £100,000 from £6.3 million a year earlier, as a challenging retail landscape put its first real dent in the company's bottom line. An exceptional charge of £5.5 million didn't help, £4.7 million of which related to an impairment on the value of the company's Singapore property. The company said it expected the trading environment would continue to be challenging, and it would be hard for anyone to argue otherwise in the current climate. The shares are now trading at an all-time low of less than 2 pence. We've already heard from betting shop firms William Hill and Ladbrokes Coral owner GVC Holdings. They've talked of the effect the new £2 fixed odds betting terminal legislation has had on profits and the shop closures that has prompted. And it's clear that the focus for these businesses now is boosting their online businesses in order to adapt and thrive. And bingo, they may have found the solution. Yes, bingo, the game the nation's grannies used to play on a Tuesday night down at their local bingo hall has gone online and made its way into the hearts of a new generation of players. And with the UK the world's largest online bingo market, it's little surprise that the likes of William Hill and GVC with its Foxy Bingo have joined the legions of companies vying for the nation's players. On Thursday, we get full-year results from Rank Group. Once better known for the Hard Rock and Deluxe media brands, the former large conglomerate sold the last of those businesses in 2006 to focus on gambling through Grosvenor Casinos and its online Mecca Bingo brands. Bingo has been at the heart of its operations since then, and having fallen in popularity, Rank has been working hard to make bingo the new go-to online gambling game for the younger generation. They've proved a tough crowd to win over, not least because of the highly competitive sector this has quickly become, but the 11% rise in its share price since the start of this year suggests Rank may be winning. Chief Executive John O'Reilly, who joined the company in 2018, has stressed the need to increase and improve its digital offering, prompting the acquisition of Spanish online platform YoBingo and now Stride Gaming. Rank is paying £114.5 million for Stride in a move that, at the same time as boosting its position, also suggests we can see more consolidation in the industry to come. It's not an overly lucrative business. The Gambling Commission reckons the aggregate gross gambling yield, which is income less winnings, for online bingo is about £165 million, and that's a drop in the ocean compared to the total yield of £5.4 billion from all web-based gambling. However, operating online means these businesses can cut out the costs associated with having shops on high streets, which is a focus for each of these firms at the moment. Rank certainly isn't getting a bargain though. It's paying 151 pence in cash for every Stride gaming share, which represents a 29% premium to their closing price the day before the deal was agreed. But Rank insists this latest acquisition will create a business with genuine scale and capability in the digital market. Stride is one of the UK's top 3 online bingo businesses, operating under the Lucky Pants and Kitty Bingo brands. It put itself up for sale after seeing its shares halve, and it's openly said it's accepting the deal amid mounting regulatory and fiscal pressures in the UK gambling sector, no doubt alluding to that £7 million it landed for failings in its anti-money laundering and social responsibility procedures last year. Stride has struggled with falling revenues and earnings, but Rank hopes it will be able to harness the considerable synergies between the two businesses and, doing so, double its digital operation and boost profits. Broker Shore Capital says acquiring Stride might pacify those who worried that Rank had yet to find a convincing route out of the high street and into e-gambling, and the acquisition could see digital revenues earnings potentially double to £41 million, although it will take time for that to show through. The question is whether Rank has overpaid. Analysts at Shore had suggested £90 million should be its best offer, and even suggested before the deal had been done that Rank might have been better off looking overseas rather than doubling down on the UK. The broker, however, rates the shares a buy, so we'll see what Rank has to say for itself on Thursday. And that's it for this week. For more on these companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.